Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe Simple Sound. Today we're diving into the world of investing, specifically exploring different ways to build and diversify your portfolio beyond just picking individual stocks. Today's episode is based on an article titled Beyond Individual Stocks: Understanding Investment Vehicles on the safesimplesound.com website, which offers a comprehensive overview of various investment options. This article highlights some key concepts like the importance of diversification, the differences between actively and passively managed funds, and the need to align your investment choices with your individual goals and risk tolerance. We'll be using these concepts as a springboard to explore several real-life scenarios and help you make informed decisions about your own investments. To guide our discussion, we'll be covering three main topics. First, we'll delve into the ever-popular debate: mutual funds versus ETFs. We'll examine this comparison through the lenses of a young professional just starting out, a retiree seeking income, and an active trader looking for an edge. Then we'll move on to closed-end funds and unit investment trusts, exploring their potential benefits for income seekers and those with fixed income needs. Finally, we'll wrap up with practical advice on building a diversified portfolio, tackling scenarios like starting small, diversifying for retirement, and maximizing growth potential for long-term investors. So get ready for an information-packed episode with clear, concise segments designed to help you navigate the exciting and sometimes confusing world of investing. In this first segment, we're putting ourselves in the shoes of a young professional just starting their investment journey. They're eager to grow their savings long-term, but are working with a smaller initial investment and are comfortable with moderate risk. Sam, Taylor, let's unpack this scenario. Given their limited initial investment, are ETFs or mutual funds a better starting point?
That's a great question, Alex. It reminds me of when I first started investing. I was so confused about the difference. I remember reading that mutual funds sometimes have minimum investment requirements, which could be a barrier for someone just starting out. Is that right, Sam?
Yes, Taylor, you're spot on. Many mutual funds do have minimums, sometimes $1,000 or even more, as mentioned in the context we read earlier. This could be a significant chunk of a young professional's initial capital. ETFs, on the other hand, typically only require the purchase of a single share, which can often be purchased for under $100, sometimes even less than $50. So for someone starting with limited capital, ETFs offer a lower barrier to entry.
Excellent point, Sam. So access is definitely a factor. Let's say our young professional has maybe $500 to start. How can this investor effectively utilize ETFs to diversify within that limited budget?
So, if I understand correctly, even with a small amount, diversification is still crucial, right? But wouldn't buying multiple different ETFs quickly eat up that $500, even if individual shares are relatively inexpensive?
Diversification is always important, regardless of your investment amount. And you're right, Taylor, buying multiple individual ETFs could become costly. This is where broad market index ETFs become incredibly valuable. A single, low-cost S&P 500 index ETF, for example, would instantly give our young professional exposure to 500 of the largest U.S. companies across diverse sectors.
That's a powerful illustration, Sam. Think of it like buying a slice of a giant, pre-made, diversified pie instead of trying to bake your own with limited ingredients. It's instant diversification with a single purchase.
That analogy makes perfect sense, Alex. So, if our hypothetical investor wants to diversify internationally, they could add an international market ETF later, as they have more capital to invest, right?
Precisely. They could progressively add ETFs focused on different sectors, international markets, or bonds as their investment grows. Another point to consider is fractional share investing, offered by many brokerage platforms. This allows investors to buy portions of even high-priced ETFs, further enhancing their ability to diversify with smaller amounts.
Great points. So let's recap. For our young professional, ETFs generally offer a more accessible entry point than mutual funds due to lower initial investment requirements. Broad market index ETFs provide instant diversification, even with limited capital, and fractional share investing can further enhance this capability.
This is incredibly helpful. I wish I knew all this when I started.
Absolutely, Taylor. We hope our listeners find this equally valuable. As a call to action, we encourage you to explore low-cost, broad market ETFs and the option of fractional share investing. It can be a fantastic way to begin your investing journey, even with a small amount of capital. And now we're going to put our knowledge to the test with another real-world scenario. Let's imagine a retiree looking for steady income and preservation of capital. They're risk-averse and prefer a hands-off approach. So, Sam and Taylor, thinking about mutual funds and ETFs, what comes to mind for this retiree? Are actively managed mutual funds or low-cost index ETFs more suitable for their goals?
Well, the article on safesimplesound.com that we read earlier talked about how actively managed funds try to beat the market, which sounds good, but they also come with higher fees. And this retiree wants a hands-off approach, right? So maybe low-cost index ETFs that just track the market make more sense. I'm thinking something like a broad market ETF or a bond ETF, maybe even a combination. But how do they get income from an ETF?
Excellent point, Taylor. For this scenario, low-cost index ETFs are generally the more suitable option. Actively managed funds, while potentially offering higher returns, carry greater risk and higher expense ratios, which can eat into a retiree's returns over time, especially since they are drawing income. Remember, the article mentioned that ETFs generally have lower expense ratios.
That's a great clarification, Sam. Now, Taylor, you touched upon the income aspect. How can this investor balance the need for income with minimizing risk in their portfolio through a combination of ETFs and mutual funds? Could both play a role?
So, if I understand correctly, ETFs are good for low cost and tracking the market. For income, maybe some bond ETFs could work. This reminds me of what we discussed about bond funds in general, providing more stable income. Could they mix in a dividend-focused ETF or maybe even a cautiously selected dividend-focused mutual fund for a slightly higher yield, even if it comes with a little more risk?
Exactly. This retiree could create a portfolio primarily composed of low-cost index ETFs tracking a broad market index and a bond index for stability. Supplementing this with a dividend-focused ETF and potentially a carefully chosen dividend-focused mutual fund could provide the additional income they seek. It's all about finding the right balance. One example could be a diversified portfolio like the conservative portfolio example in the article, a mix of broad market, bond, international, and REIT ETFs.
Great example, Sam. Let's recap. For our risk-averse retiree seeking income and a hands-off approach, low-cost index ETFs, particularly broad market and bond ETFs, form a solid foundation. Supplementing with dividend-focused ETFs or even a selectively chosen mutual fund can boost income potential. The key is managing risk through diversification.
This is starting to make sense. But what if the market takes a downturn? Won't the dividend payments decrease too?
That's a valid concern, Taylor. Dividend payments are not guaranteed and can fluctuate based on company performance. However, a well-diversified portfolio across various sectors can help mitigate this risk. For example, a utility company might maintain steadier dividends even during an economic downturn compared to, say, a cyclical consumer goods company.
Right. Diversification is key. Think of it like having multiple streams flowing into a reservoir. If one stream dries up temporarily, the reservoir still has other sources to maintain its level.
That's a helpful analogy, Alex. So if I understand correctly, by diversifying with different types of ETFs and maybe a carefully chosen mutual fund, our retiree can create a more stable income stream, even during market fluctuations.
Exactly. Remember, we're not giving specific investment advice here, but providing educational resources. To take the next step, listeners, compare expense ratios, dividend yields, and historical performance for various income-focused ETFs and mutual funds. Don't hesitate to consult with a qualified financial advisor to tailor a strategy that meets your specific needs. This will help you make informed decisions aligned with your individual circumstances.
And if you need personalized guidance, you can reach out to us at safesimplesound.com/contact.
This time, we're putting ourselves in the shoes of the active trader. This is an investor who's comfortable with higher risk, actively manages their portfolio, and might be particularly interested in specific sectors or market timing strategies. Sam, Taylor, are you ready to dive into this scenario?
Ready to go, Alex. This sounds like it could be pretty relevant to a lot of listeners, especially those who are a bit more hands-on with their investments.
Absolutely. This is where the nuances between ETFs and mutual funds really start to come into play.
Exactly. So, Sam, let's start with this. How can ETFs be leveraged for sector-specific investing and tactical asset allocation?
ETFs are particularly well suited for these strategies. Let's take sector-specific investing first. Say you're bullish on renewable energy. You could buy an ETF that specifically tracks a renewable energy index. This gives you diversified exposure to that sector without having to research and buy individual stocks. For tactical asset allocation, that is, shifting your investments based on market conditions, ETF's intraday tradability is a huge advantage. You can quickly move into or out of sectors or asset classes as your market outlook changes.
So, if I understand correctly, if I think the tech sector is about to boom, I can buy a tech sector ETF and then sell it quickly if my prediction proves wrong.
Precisely. That kind of agility isn't as easy with mutual funds, which are priced only at the end of the trading day.
Excellent point, Sam. That daily pricing of mutual funds can be a real limitation for active traders. Now, let's flip the coin. Are there scenarios where actively managed mutual funds might outperform ETFs for this type of investor, Sam?
Yes, there are a few situations. For example, in less efficient markets like emerging markets or small-cap stocks, an active manager might be able to identify undervalued companies more effectively. Their expertise could potentially lead to higher returns than a passively managed ETF that simply tracks an index. However, it's important to note that this outperformance isn't guaranteed and comes at the cost of higher expense ratios.
Those fees can really eat into your returns over time, right? So even if an actively managed fund does outperform, the higher fees might negate some of that benefit.
Exactly right, Taylor. It's a trade-off between potential outperformance and cost. There's also the tax efficiency angle to consider. ETFs are generally more tax efficient than mutual funds, which can be important for active traders who are frequently buying and selling.
That's because of the way ETFs are structured. They typically don't distribute capital gains as frequently as mutual funds, which can help minimize your tax burden.
So, to recap, ETFs are generally preferred for active traders due to their intraday trading, sector-specific options, and tax efficiency. However, actively managed mutual funds might be considered for certain niche strategies, particularly in less efficient markets, where active management could potentially add value. But remember, past performance is not indicative of future results, and higher expense ratios can significantly impact overall returns.
So, as an active trader, I need to weigh the potential benefits of active management against the higher costs and potential tax implications. And if I'm focusing on specific sectors, ETFs seem like a powerful tool because I can get in and out quickly.
That's a great summary, Taylor. To wrap up this section, we encourage all our listeners to research sector-specific ETFs and really consider the tax implications of frequent trading. It's crucial to understand how these factors can affect your overall investment strategy. Next, we're putting on our income seeker hats. Imagine an investor, let's call her Sarah, whose primary goal is generating a healthy income stream from her investments. She's comfortable with a moderate level of risk and is intrigued by closed-end funds, or CEFs, because of their potential for higher yields. Sam, Taylor, help us unpack this. Sam, let's start with the big picture. What are the potential benefits and risks of using CEFs for income generation compared to, say, traditional mutual funds or ETFs?
Good question, Alex. CEFs can indeed offer some attractive advantages for income-focused investors like Sarah. As we discussed earlier, they often invest in specialized sectors or strategies that can generate higher yields than broader market funds. Plus, some CEFs use leverage, which can amplify returns, though this also magnifies potential losses. So, higher income potential is a definite plus. However, the risk side is equally important. CEFs trade on exchanges like stocks, meaning their prices fluctuate throughout the day and can deviate from the actual value of their underlying assets, the net asset value, or NAV. This can lead to buying at a premium or, interestingly, a discount.
So, if I understand correctly, a CEF trading at a discount means I could potentially buy its underlying assets for less than their actual worth. That sounds almost too good to be true.
That's the basic idea, Taylor. But it's not quite that simple. The discount might reflect real concerns about the fund's future performance, management, or the specific assets it holds. It's not free money.
That's a great point, Sam. It's like buying a used car. A lower price might be a bargain, or it might mean there's something wrong under the hood. Taylor, your question brings us to my second question. How can an investor like Sarah identify and evaluate CEFs that are trading at a discount or premium?
Research is key. Investors need to look beyond the headline discount or premium and dig deeper into the fund's holdings, its historical performance, its management fees, and the reasons behind its current valuation. For example, a CEF specializing in municipal bonds might trade at a premium because of the tax advantages those bonds offer, while a CEF focused on a sector currently out of favor might trade at a discount.
So if Sarah is looking for high income, she might be drawn to a discounted CEF, thinking she's getting a deal. But she also needs to understand why it's discounted. It could be a temporary dip, or it could signal deeper issues, like the fund holding a lot of risky high-yield bonds that are likely to default.
Exactly. A good analogy is a retail store having a sale. Sometimes it's just clearing out inventory. Other times it's because the clothes are out of style. You have to discern the difference.
Let's recap. CEFs can offer higher yields, potentially boosted by leverage, which is attractive for income seekers. However, their market-based pricing introduces the element of discounts and premiums to NAV. While a discount might seem appealing, thorough research is crucial to understand the reasons behind it. It's not enough to simply chase yield.
So if Sarah were looking at two CEFs, both with a similar yield, but one trading at a discount and the other at a premium, she shouldn't automatically jump on the discounted one, right? She needs to compare their holdings, management fees, and past performance to see which offers better value.
Precisely. And consider the broader context. Are interest rates rising? Is the sector the CEF invests in facing headwinds? All these factors play a role.
Excellent points. Before we wrap up, let's give our listeners a clear call to action. If you're considering CEFs for income, take the time to research CEF discounts and premiums, management fees, and, crucially, the fund's portfolio holdings. Understand what you're buying and why the market is pricing it the way it is. Next, we are focusing on fixed income needs. Let's imagine an investor, perhaps someone approaching retirement, looking for a diversified bond portfolio with a predictable income stream. They're particularly interested in unit investment trusts, or UITs. Sam, how can UITs be used to create such a portfolio? And what are their advantages and disadvantages compared to other options like bond ETFs or mutual funds?
UITs are a great option for this type of investor. They're essentially a basket of bonds bundled together and sold as units. Because the holdings are fixed, the income stream is relatively predictable. To build a diversified portfolio with a UIT, an investor could choose a UIT that holds various types of bonds, such as corporate bonds, government bonds, and perhaps some high-yield bonds for a bit more return potential. Think of it like a pre-made bond platter. You get a variety of flavors without having to pick each one individually.
So, if I understand correctly, the diversification is built into the UIT itself. I don't have to select individual bonds like I would if I were building my own bond ladder.
Precisely. That's one of the main advantages. And like a bond ladder, UITs have a maturity date. Once that date is reached, the underlying bonds are sold and the proceeds are distributed to the investors. This defined time frame can align well with specific financial goals, like funding a child's education or supplementing retirement income for a set period.
This reminds me of our previous discussion about target date funds, where the asset allocation shifts over time based on a predetermined retirement date. While UITs don't dynamically adjust like target date funds, the defined maturity offers a similar level of predictability. But Sam, what about the downsides? The article mentioned no active management for UITs. Could that be a disadvantage?
Good point, Alex. The lack of active management means the portfolio composition remains static, even if market conditions change. This can be a disadvantage if interest rates rise significantly, as the UIT's relatively fixed yield could become less attractive. A bond fund manager, on the other hand, could actively adjust the portfolio to capture higher yields in a rising rate environment.
So, let's say interest rates go down after I've invested in a UIT. Wouldn't the fixed income stream of my UIT be more appealing than newer bonds with lower yields? Isn't that an advantage?
Absolutely, Taylor. That's a great example of how the fixed nature of UITs can be beneficial. It's a double-edged sword, predictability in both up and down markets. Another potential downside is liquidity. While UITs are traded on exchanges, they might be less liquid than bond ETFs, especially specialized UITs.
Let's recap. UITs offer a convenient way to access a diversified bond portfolio with a predictable income stream and a defined maturity date. However, the lack of active management can limit their flexibility in changing market conditions, and their liquidity can be lower compared to bond ETFs. Now, Sam, how do the costs of UITs compare to bond ETFs or mutual funds?
Generally, UITs have lower ongoing costs than actively managed mutual funds because there's no active trading or research involved. Their costs are often comparable to, or even lower than, passively managed bond ETFs. However, it's crucial to look at the specific expense ratio of each investment before making a decision.
This is all starting to click. So if I'm looking for predictable income over a set period and I'm comfortable with a fixed portfolio, a UIT might be a good option. But I need to carefully consider the potential impact of changing interest rates and compare the costs to similar bond ETFs and funds.
Exactly, Taylor. That's a great summary. For our listeners, the key takeaway here is to understand the fixed-term nature of UITs and diligently compare their costs and features to those of comparable bond funds and ETFs before making an investment. Be sure to research and understand the specific holdings within a UIT to ensure it aligns with your diversification goals. Now we're back to focusing on starting small. Imagine a beginner investor, Swift. Maybe that's even you listening right now, who wants to build a diversified portfolio but has limited funds. This can feel daunting, but it's absolutely achievable. We have Sam here again to help us break it down.
Thanks, Alex. Glad to be here.
So, Sam, for someone like our hypothetical Swift who's just starting out, which investment vehicles are most suitable for them given limited capital? And how can they diversify across different asset classes with a small investment?
Great questions, Alex. For beginners with limited capital, exchange-traded funds, or ETFs, are usually an excellent starting point. Remember, ETFs trade like stocks, but they represent a basket of securities, providing instant diversification. You can buy just one share, often for less than $100, which makes them accessible even with a small budget.
This reminds me of what we discussed about mutual funds. Are ETFs similar?
They are similar in that they both offer diversification. However, ETFs generally have lower expense ratios than mutual funds and offer more flexibility because they trade throughout the day like stocks. Mutual funds often have minimum investment requirements, which might be a hurdle for someone starting small.
So, Taylor, imagine you have $500 to invest. How might you diversify that using ETFs?
So if I understand correctly, I could buy shares in a few different ETFs, each focusing on a different asset class. Perhaps one that tracks the S&P 500, another focused on bonds, and maybe even a small portion in an international market ETF.
Exactly. That's a great example of how to diversify even with a small amount. You're spreading your risk across different segments of the market. Let's say you allocate $300 to a broad market ETF, $150 to a bond ETF, and $50 to an international market ETF. That simple allocation instantly diversifies your $500 across stocks and bonds with a touch of international exposure.
Sam, this is a great practical example. Could you expand on how choosing different types of ETFs within these asset classes helps with diversification?
Absolutely. Even within stocks, you can further diversify. For instance, instead of only focusing on large U.S. companies, you could include small cap or mid cap ETFs, or even look into sector specific ETFs like technology or healthcare after you've established your core positions. This further distributes your risk.
This is really helpful. But how do I know which specific ETFs to choose? There are so many.
That's a common concern, Taylor. Look for low cost, broad market ETFs to start. These track major indexes and provide good overall market exposure. As you become more comfortable, you can explore specialized ETFs. Another great option, especially when starting with a smaller amount, is to consider robo-advisors. They automatically invest and manage your portfolio based on your risk tolerance and goals, often for very low fees.
Let's recap. For those starting with limited funds, ETFs are an accessible and effective way to diversify. Start by focusing on broad market, low cost ETFs across different asset classes like stocks and bonds. Even small, regular contributions can make a significant difference over time. Robo-advisors are also a great option for beginners.
So to be clear, I don't need thousands of dollars to get started. Even $50 or $100 invested regularly can help me build a diversified portfolio.
Absolutely. Consistency is key. Small, regular investments, coupled with the power of compounding, can lead to significant growth over the long term. For our listeners, we encourage you to explore low-cost, broad market ETFs and consider the benefits of robo-advisors, especially if you're just beginning your investment journey. Let's focus again on this specific scenario because it's very important. Diversifying for retirement. Imagine someone nearing retirement, looking to adjust their portfolio to minimize risk and generate income.
This is really relevant for me, Alex. My parents are starting to think about this, and I've realized I need to get a handle on it for myself eventually, too.
Absolutely, Taylor. It's a crucial stage in financial planning. Sam, let's start with asset allocation. How should someone's asset allocation change as they approach retirement?
Generally, as retirement nears, the focus shifts from growth to capital preservation and income generation. This means gradually reducing exposure to higher risk assets like stocks and increasing allocation to lower risk options like bonds. Think of it like adjusting the sails on a ship as you approach the harbor. You want a smoother ride.
So if I understand correctly, you're saying someone who might have had 80% of their portfolio in stocks in their 30s might aim for something closer to 50% or even less as they get closer to 65.
Exactly. The precise allocation depends on individual circumstances, risk tolerance, and retirement goals, but the general trend is a shift towards lower risk.
That makes sense. Now, Sam, considering this shift towards lower risk and the need for income, which investment vehicles are most appropriate for someone in this situation?
Several vehicles can be helpful. The article we are discussing now mentions bond funds, balanced funds, and target date funds. Bond funds offer a steady income stream, balanced funds provide a mix of stocks and bonds for a balanced approach, and target date funds automatically adjust their asset allocation as you approach your retirement date.
This reminds me of what we discussed about ETFs last time. Could ETFs also play a role here?
Absolutely. Bond ETFs can be a cost-effective way to access the bond market, and dividend-focused ETFs can provide regular income from stocks. REIT ETFs, which invest in real estate, can also offer diversification and income potential.
To clarify for our listeners, REIT stands for Real Estate Investment Trust, and they can be a good way to include real estate in a portfolio without directly owning property.
So if someone is nearing retirement and wants a more conservative approach, they could potentially use a combination of bond funds, balanced funds, and maybe some dividend-focused ETFs.
Precisely. A conservative portfolio might look something like 40% in a broad market ETF or a balanced fund, 40% in bond funds, and the remaining 20% divided between international ETFs and REIT ETFs for additional diversification and income potential. This is just an example, of course, and individual circumstances will vary.
That's a helpful illustration, Sam. It's important to remember that diversification doesn't just mean owning different things. It means owning things that react differently to market fluctuations. So combining stocks, bonds, and perhaps some real estate can provide a more stable portfolio overall.
Okay, that makes sense. It's not just about how many things you own, but the types of assets and how they behave relative to each other.
Exactly. So to recap, as we approach retirement, we generally want to shift towards a more conservative asset allocation, focusing on capital preservation and income generation. Investment vehicles like bond funds, balanced funds, target date funds, and ETFs can help achieve this. As a call to action for our listeners, take some time this week to review your current portfolio, especially if you're nearing retirement. Consider your risk tolerance, income needs, and long term goals. And as always, consult with a qualified financial advisor for personalized guidance. They can help you navigate the complexities of retirement planning and create a strategy tailored to your specific needs. Let's focus on maximizing growth potential. Our scenario features a young, high earning individual looking to supercharge their portfolio's growth while keeping risk at a manageable level. Let's start with a fundamental question. Sam, what is an appropriate asset allocation for long-term growth, particularly for someone in this scenario?
For a younger, high earning individual with a longer time horizon, a more aggressive approach is often suitable. This might involve a larger allocation to equities, potentially 70% or even higher, depending on their risk tolerance. The remaining portion could be allocated to fixed income securities like bonds to provide some stability.
So, if I understand correctly, because they have more time to recover from potential market downturns, they can afford to take on more risk with a higher equity allocation. This reminds me of what we discussed about risk tolerance in a previous episode.
Exactly, Taylor. It's all about balancing risk and reward. Now, Sam, which investment vehicles are best suited for capturing higher returns while managing risk in this situation?
Given the goal of maximizing growth, a core holding of broad market index ETFs could be a great foundation. These offer diversified exposure to a large number of companies, mirroring the performance of the overall market. Think of an ETF like a basket of stocks representing, say, the S&P 500.
Okay, so that covers the broad market, but what about getting a bit more specific? Say, investing in particular sectors that have high growth potential.
Absolutely. Sector-specific ETFs, focusing on areas like technology, healthcare, or renewable energy, can offer more targeted exposure to high-growth industries. However, with higher potential returns comes higher risk, as these sectors can be more volatile.
That's a crucial point, Sam. Diversification within the equity portion is key. Let's use a real-world example. Imagine investing solely in tech stocks during the dot-com bubble. While some saw incredible gains, many suffered significant losses when the bubble burst. A diversified approach would have mitigated some of that risk.
So even within equities, spreading investments across different sectors is important, right? And what about international markets? The article mentioned international ETFs.
International exposure is another essential component of diversification, offering access to growth opportunities outside your domestic market. Emerging markets in particular can offer high growth potential, though they also carry higher risks.
Let's recap. We've discussed the importance of a higher equity allocation for long-term growth, the use of broad market and sector-specific ETFs, and the benefits of international diversification. Taylor, does that make sense so far?
Yes, it's starting to click. It seems like building a growth-focused portfolio is about strategically balancing higher risk, higher reward investments with some stabilizing elements like bonds. And diversification, not just across asset classes, but also within equities, is crucial.
Precisely. And remember, it's not a set-it-and-forget-it approach. Regular portfolio review and rebalancing are crucial to maintain the desired asset allocation and adjust to changing market conditions.
Excellent point, Sam. This is where the simple in Safe Simple Sound comes into play. Even with a growth-focused strategy, maintaining a disciplined approach is key. So the key takeaways for maximizing growth potential are to leverage a higher equity allocation, diversify across and within asset classes, consider targeted investments in high-growth sectors and international markets, and remember the importance of regular portfolio review and rebalancing.
And don't forget about risk tolerance.
Absolutely. Your call to action, listeners. Research growth-focused ETFs and consider your long-term investment horizon. And that concludes our deep dive into the world of investment vehicles here on Safe, Simple Sound. We explored a range of options beyond individual stocks, from the familiar territory of mutual funds to the modern flexibility of ETFs, and even touched on the specialized uses of closed end funds and UITs. Just like the article highlighted, finding the right vehicle depends on your individual goals, risk tolerance, and time horizon. We really hit on how crucial diversification and cost analysis are when making these decisions. I think the discussions around the young professional just starting out and the retiree seeking income were particularly illuminating, showing how these investment choices can apply to different life stages. It really brought home the message that there's no one-size-fits-all solution. Thank you for lending us your ears today. We truly appreciate you being part of the Safe, Simple Sound community. Don't forget to check out the show notes for links to all the resources we mentioned. We'd also love it if you could leave us a review or share this episode with someone who could benefit from this information. In next episode, we'll be tackling the fascinating topics like investment analysis and strategy. So be sure to subscribe so you don't miss out. Until then, stay curious, stay informed, and stay safe. This is Alex, signing off.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.